Welcome to this short debrief of question 3 from the September-December 2021 exam for AFM. This question has been slightly adapted because professional skills marks have been brought in since this exam was set. But the broad thrust of the question is the same. This is not meant to be a technical debrief of the question. We're just going to look at it as an overview and to look at the sorts of problems that people might have had with it and what you can learn going forward. So the first point is that this question is not a question on some of the core areas of AFM like currency hedging, interest rate hedging, net present value and so on. This question is on the section of the syllabus that covers restructuring and reorganisation. And one of the big problems that people had with this question was that they were question spotting. They didn't expect this to come up. And question spotting is a big problem with AFM. People don't seem to go into the exam with a working knowledge of the whole syllabus. Now, a working knowledge isn't the same thing as being an expert on all areas, but you've got to have studied the whole syllabus and have something to say on each area. So question spotting, don't do it for this exam. Do not analyse what comes up and make predictions about what you think is going to come up in the real exam, because that's what a lot of people did here, and for me that's one of the main learning points. And the ACCA examiner's report noted that many candidates didn't score many marks here at all. And if you are scoring very few marks on a question, then obviously your chances of passing the overall exam are going to be low. So that said, let's have a look at what's going on here. Well, we're looking at a shoe manufacturer, Hanwood shoes, and it is looking at selling off one of its divisions and the impact that that would have on its statement of financial position and, as we'll see, its earnings per share as well. Now, it's important not to plunge straight into calculations. You're given a scenario for a reason, and that's because AFM is meant to be as much about management as advanced finance. So it's important that you allow yourself approximately 10 minutes planning time for these 25 mark questions. I would generally start by looking at the requirements, and that works quite well here. You would allow yourself 1.95 minutes per mark for the technical marks. The first thing we had to do here was calculate the expected price of a division that you're thinking of selling off. So this requires you to think about the business valuation section of the syllabus and the various valuation techniques that you can draw on there. But it's a two-part question. You also have to demonstrate the impact of the sale on the finances of the company. And in fact here it is the statement of financial position and the forecast earnings per share. And to help with the statement of financial position, you were provided with the current statement of financial position, and this was provided as a spreadsheet, and you could simply copy this into your answer. And that would mean that you've got the current statement of financial position and you can make various adjustments to it. That's the bulk of the question. We then have to discuss whether investors are likely to be satisfied with the sale of the division and its consequences for profits and funding. So with that in mind, you would then spend some time reading through the detail. Now, this isn't a technical debrief, so I'm not going to read through the detail too much. Basically, in the first exhibit, we're told a little bit about the sort of company we are and why we're thinking of selling one of our divisions. Exhibit 2 gives us some information about the future direction of the company. And Exhibit 3 allows us to value the division that we're thinking of getting rid of, and we can do that using a present value approach. Discount factor is given in the first note to Exhibit 3. Then we've got some cash flows to discount. These are already after tax. And all we have to recognise is that after that final year, there's going to be continued growth at 3.5% per year. So we're going to do an MPV to say how much we think we can sell the division for. Now, once we sell the division, it's going to have various impacts on our earnings per share. We're told in note 3 how much profit we get from this division, so that's going to be lost. And we're told that when we get the money, however much money it is, we're going to do various things with it. Pay off some loan notes, put some more into current assets, invest some more into non-current assets. Any profit that we make on the sale of the division, we're told to take to reserves. And then we're told that if we sell the children's shoes division, we're going to lose their assets. Any of the money that we invest, we're told what return we're going to get on it. So there's a sense of direction here. We could do a valuation. We can adjust this statement of financial position copied from the Excel spreadsheet given in the question directly into our answer, and we can make some adjustments. And for sure, we'll make some mistakes. It is absolutely not intended that you get everything right in this exam, but that's your broad sense of direction. Once you've got some numbers, well, what do we think the investors are going to feel about the sale? And to some extent here, we can comment on the numbers. Earnings per share, gearing, the profit that we've made on the sale. But we can also talk about strategic factors, because if you sell off one of your divisions, you're a less diversified company, and you can pick up on the details within the scenario to see if you think that would matter to these investors. And you can make up to 2 marks per point in these discussion areas, but only if you relate your point closely to the scenario. So what do you mean, and why does it matter here? Finally, professional marks will be awarded from the September 22 exam onwards. And here you would have scored professional marks by choosing the right approach for your valuations, for commenting on the assumptions that you make as you are performing your forecasts and your valuations, and thinking about practical considerations. Are there any other strategic alternatives for this company? So analysis, evaluation, skepticism, and commercial acumen. And that completes this brief overview. This was a question that really is perfectly manageable. It's difficult to score all of the numbers, all of the calculation marks. It's difficult to score 100% there, but it's not difficult to score comfortably more than 50 and to make good discussion points too. And that's really got to be your approach, not to expect perfection, but to come up with a professional answer to this sort of problem.